Well, good morning, everybody. Thank you so much for attending this Section 174 webinar hosted by Corporate Tax Advisors. We've got clients, friends, and CPA partners from all four time zones in the U.S. joining us this morning. So thank you. We know this is a hot topic. And again, thank you for using us as your trusted resource for credits and incentives. So we've got Mike Weber here today who will walk through our updates to Section 174 strategies. And we will walk through this, and then this is an open Q&A session, which again, if you have any questions or not able to join us today, this recording will be supplied and you can always reach out. So with that being said, we'll jump into our Section 174 legislative update.
All right. Thank you, Jordan, and good morning to all of you out there listening in this morning. Welcome to our update on Code Section 174, the requirement to capitalize and amortize research and experimentation expenditures. There's a lot going on in this area, and so we're here this morning to give you the latest news, even though nothing definitive has been decided from a congressional standpoint. So with that, let's jump in to what we have to share with you today. I want to remind you that if you have any questions, you can put those into the chat. Jordan will share those as we go through. A little bit about CTA. We've been around a little over 10 years now. Dawson Furco and I co-founded the firm back in 2014. We focus solely on these tax incentives and credits, one of them being the research and development tax credit. So we work with CPAs on a national basis. And again, welcome this morning, and we're glad you're with us. As we look into 174, I'd like to start out by just giving you a brief history so that we understand where we were, where we are today, post 2022, and then where it looks like we're going with 174. Pardon me. So everyone probably remembers prior to the Tax Cuts and Jobs Act back in December of 2017, research and development expenses were considered ordinary and necessary business expenses. And if you looked at Section 162, it referred you to Section 174, which allowed you to take a deduction. And if you wanted to defer some of those costs, match them with future revenue, you had an election you can make to capitalize and amortize. Well, along comes this act at the end of 2017. It does a lot of good things for taxpayers. For instance, it lowers the corporate tax rate down to 21%. That was probably the biggest plus to taxpayers. But then it also did some bad things, like it limited state income tax deductions to $10,000 on everybody's Schedule A. So that was a big negative to taxpayers. And then the biggest negative that came out of it was there was this sense that we needed to pay for the cut, the rate cut from the maximum rate from 35% down to 21%. And so this research and development amortization came in as a timing difference, as a way to help pay for some of the provisions of that act. All right. So we get all the way up through 2022 or to the beginning of 2022. And during that 4-year window, there was a lot of lobbying, a lot of discussion about this is going to be a very negative impact on taxpayers as 2022 approaches. And so for 4 years, they worked hard, but the law did not change. So now 1/1/22, 174 language flips basically and does away with the deductibility of research costs. And now you must amortize those. if they're domestic over 5 years, and certainly if you have any foreign research costs, those really go out over 15 years. So negative impact. And now we come to 2024, and we're 2 full tax years into the implementation of this. So we've got our 2022 year, our 2023 year, which some taxpayers may have already filed for the 23 years. Some may be extended, but 2 years in, and we are waiting to see what's going to happen with this law. Is it going to stay this way, or are we going to get a chance to maybe push it off or have it repealed moving forward? So we're going to talk a little bit more about that today. So let's move to the next slide, and let's talk about what is HR 7024. What is really in this thing? The good news is it was introduced back in mid-January of this year. There's been lots of bills introduced over the last 6 years on this, by the way. This is the one that has the likelihood of moving forward, though. It's called the Wyden-Smith Act because of the bipartisan group that put it together. But you can see here on the slide that it was approved by a majority of the House. And so that is a bipartisan vote. So that's also good news. So each side has some things in it that they like, and they're willing to push it forward as one tax bill. So that is good news. So now, after it comes out of the House, it's currently sitting in the Senate, and we've got some dynamics there that we'll share a little bit about here in just a second. But let's look at specifically what's in it, because everybody's talking about it as the 174 bill, the bill that will allow us to deduct our R&D expenses in the year incurred. So that is in there, and it would be a retroactive back to 1/1 of 22 removal of this requirement to amortize. And we're going to talk about how we're going to get back to that, what the method change will look like here in a few minutes too. But it also was set to end the employee retention credit early. Everybody probably knows that for ERTC, you can claim that for 2020. Quarters in 2020, where you had a shutdown, a partial shutdown, or you had a substantial revenue reduction. Those claims, the ability to claim those for 2020 expired April 15th, so just about a week ago. But for 2021 quarters, where you have those requirements met, you can still claim the ERTC all the way out through 4/15 of 2025. So about another year to go. So one of the incentives to get this tax bill through was to end the retention credit immediately upon signing this bill. So that provision is still in there. Another important thing for businesses is 100% bonus depreciation. I'm sure all of you realize that we are phasing out the bonus depreciation right now at 20% a year over 5 years. And so that was a big benefit to businesses that were buying a lot of equipment, building facilities, the ability to really take advantage of a cost segregation study, for instance, was having the ability to deduct 100% of those costs. So this bill would return that as well. So something you don't hear much about, but a huge benefit to the business community. Interest expense limitations, those came about in the Tax Credit and Jobs Act back in 2017. And those weren't really favorable to taxpayers, so it's gonna repeal and change some of those rules. But the biggest one here, second bullet from the bottom, is an increase in the child tax credit. And that's going to be increasing the benefit of the child tax credit. And it's also going to be kind of a maybe a loosening of the requirements necessary to be able to claim the credit. So the idea here is the child tax credit will be available to a broader broader base of citizens here in the U.S. So that is the primary push and pull in the 174 legislation, or in this HR 7024, is the interplay of 174, which is pro-business, and then the child tax credit, which is pro-individual. And so those are the dynamics that we're dealing with. And incidentally, it's not an offset one way or the other. These are both big spending items, big costs, net costs to the Treasury, if this bill goes through. And that is probably some of the holdup and hesitation. So now that we know what's in the bill and how important it is if to be passed here for all taxpayers, I'd like to share with you a little bit about where it stands, just to give you a little bit of insight. Again, this is information that comes out of a coalition we put together with other research and development firms around the country. We've got one out of Florida, we've got a couple out of the New England area, and then one out of the Midwest. It's the R&D provider community is a relatively small community. And so we're working with some other firms to get some insight and be able to follow what's happening in Washington with this bill. So we'll cover the next few slides quickly. I just want to give you a flavor of what the holdup is here. So the first thing is, remember, this bill passed the House back in January. Now it has to come to the Senate before it can go on to the president to be signed into law. And the Senate is where some of the issue is. So on March 22nd, this bill, moved forward, but it seems in danger of dying now in the Senate because there's some Democrat and Republican push and pull again, just on the Senate side. So let's look at it. Schumer moves. He's in charge of saying what gets on the floor and what bills get debated. So on March the 21st, he introduced this bill. He's also got an interest in passing it, and he apparently is willing to push it forward. But it was not received well, and that's very unfortunate given the bipartisan support it got in the House. So our source out of DC is reporting that it's mostly the Republicans that are kind of pushing back at the moment right now. They do feel like being the Republicans, feel that they have a chance at controlling the House and the Senate in this fall after the election. And they might be able to get a, quote, better tax bill if they wait. Okay. Um, we've got, if you look at this slide, for instance, we've got John Thune, who's a very, been around the Senate a long time, holds a lot of authority. A lot of other senators look to him for where where they should place their vote, and basically they are deciding that if this is really pushed by Schumer, they will filibuster this bill because, again, they feel like they can get a better bill. We don't know what a better bill is, but that is what our news sources are hearing. And then there's, of course, this dynamic of these folks that are running to replace Mitch McConnell as the GOP leader. So there's a lot of dynamics that are going on behind the scenes that are not really things that that are debating the merits of the bill. Seems to be a little bit of posturing, is what we're hearing. So um, uh, as recently as a couple weeks ago, April 10th, there are a group of senators that are trying to push this bill through by attaching it to different legislation so that it doesn't stand alone. It can just get passed as part of another package. And so there's this radiation this radiation exposure act that is out there. They're trying to attach it to that, which will be coming up for votes here very soon. And then there's also a couple of other legislative opportunities here at the end of April, early May, that they may be able to attach the 174 bill to and push it through prior to the election. So there is still at this moment today, April 23rd, a big push to move this legislation forward. It hasn't just stopped in the Senate. There's still a push to get it done. And even Ron Wyden, the sponsor of the bill, there's a full court press to get it done. So I don't want anyone out here to think that it's not moving forward. There is still a large effort to move it forward. So where does that leave us here in this group? What do we need to do? Obviously, we've got a situation where this may be the new reality, that we will always have to amortize our 174 expenses, or at least have to amortize them for the foreseeable future. Or we'll get something done here at the last minute here this spring. So for the tax preparers and the taxpayers out there, let's kind of talk about where we'll be under either direction that it goes. So if the legislation passed, that would probably be the best news for taxpayers, because it will remove the requirement for capitalization until 2026, 1/1 of 26. So kick the can down the road, as you say, or as they say. I think everybody who's a preparer on this webinar realizes the more they kick it down the road, the less likely it's ever really implemented. So even a deferral of this would be a really positive thing for taxpayers. So if that happens, in the bottom section there, this would allow for a retroactive treatment back to 1/1 of 22, and there would be taxpayer refunds. Now, we've heard it could be a cash refund. We've heard that it might be some sort of a tax credit to the 23, 24, and maybe even 25 tax liabilities. So we're not sure which direction the actual cash flow would go, but there would be refunds. And if you think about it, you'd be deducting, you'd be going back to deduct 90% of your 2022 R&D costs, and also 90% of your 2023 R&D costs. So it could be a big benefit back to you. And this will all be processed, as you can see in the third bullet point there, as a 481 adjustment through an automatic accounting method change on Form 3115. So kind of the same treatment we had getting into 174. You just back right out of it through a 3115 adjustment. So that would be the best case scenario for everybody. However, if it's not passed, or we're going to have to start doing some planning. We're going to have to start understanding and really being sure that we have our 174 position well documented. Because if you think about this, this 174 issue is a great collection opportunity for the IRS. You've got the situation where some people are gonna say, I've taken an R&D credit for the last 15, 20 years. Now I'm not going to take the R&D credit, so I do not have to do the 174 adjustment. If that's what you did in your 2022 tax returns, the IRS is going to love you. The 174 adjustment has nothing to do with your R&D credit, and whether you take one or have never taken one. So it is a really, really big opportunity for the IRS to collect from small business. Now we see back in the fall, Notice 2363, the IRS has laid out their rules and how they think different costs and different situations should be accounted for in 174. So now that we have that notice out, there's guidance, there is certainly an indication that they are prepared to audit this issue and make adjustments for it. We are hearing from the Internal Revenue Service, we're also starting to see them already in general corporate audits, that the 174 question is being asked. What are your 174 costs? What's your policy? How are you accounting for them? And the last bullet point here, please remember 174 can apply to everyone. Now, there's obviously going to be some industries, maybe retail, travel and entertainment are some ones that come to mind here. Probably not going to ever have a lot of research and development activities, but if you're a manufacturer, if you're improving and developing new products, you're going to have a 174 adjustment. And again, I'd like to remind you, it doesn't matter whether you're taking the research credit or not. So those are the two positions that we have to think about a little bit. Which direction are we going to go? Hopefully we'll have some clarity on that here in the next month or two. So now I would like to just take a few minutes and remind everybody of what 174 is, how it differs from costs that we look at for the R&D credit, which most of you are probably more familiar with. Remember, 174 is a much broader concept. They have worded it on purpose to be able to capture a lot more in costs than you ever would if you were considering the research credit. So remember, in the R&D credit, there's really only 4 categories of cost. It's the box one, or the taxable wage to the individual doing the work that qualifies. It's supplies. It's the kind of a vague area, which is cloud or computer, rental costs. And then it's 65% of any subcontracted individuals or companies that you use to help in the research effort. So as you can kind of see here, the graphic to the right, Section 174, much bigger pie. R&D credit costs, qualified research expenses, much smaller pool within the 174 bucket, if you will. So what are the rules once you've identified these costs? If you look at the box here on the left on this slide, we're going to identify all these costs, much larger pool of costs. And if they're all domestic related, it's 5 years that we're going to amortize those. And remember, we get the old midpoint adjustment in the amortization. So really, the first year, you're only able to deduct 10% of these costs. And then from there, it's 20% the next 4 years, and you get in the 6th year, your last 10%. So it's really a 6-year write-off of these costs, six tax returns. Certainly, 174B and C define what a specified research and experimentation expenditure is. So let's get into that a little bit. What are some of these rules? What is a specified research expenditure? What should you be looking for if you're a taxpayer, or you're a CPA with a taxpayer as a client that's confused by this and trying to figure out, do we have to make an adjustment here? So the definition, if we look at 174, are expenditures that are incurred in connection with the taxpayer's trade or business, which represent research and development in the laboratory sense. Okay. So that's how it was originally written in right into the code. And so some taxpayers look at that and go, well, we're not running our business, doesn't have a laboratory type environment. So maybe 174 is not something that we have to look at. We're going to show you why when they got to the notice, it really expands beyond just a pure laboratory expense here in a minute. And then in the bottom section of this slide includes all costs incidental to the development or improvement of a product. So again, now we're getting broad based again. All costs incident to the development or improvement of a product. So it doesn't mention costs incurred in a laboratory sense. Okay. Now, this is something that's really interesting as we get into Notice 2363, where the IRS is attempting to clarify the code here and or at least explain how they're going to be looking at it, right? And so they go into the detail of what is a specified research expenditure. At the bottom of this slide, the most important thing to realize is something that's new and different than what we've ever seen in the research cost and credit world is obviously software development activities are all going to be included. So wow, that industry, imagine being told that 90% of the costs you incur in your software development business, imagine being told those are not deductible. What business can operate and only be able to deduct 10% of their costs every year? It's the burden is tremendous on that industry. But if you look at the second bullet point under SRE activities, it says research or experimental activities in the experimental or, all right, not just laboratory, but experimental or laboratory sense. So again, broadening the activities that is intended to discover information that would eliminate an uncertainty concerning the development or improvement or, and this is the new part, appropriate design of a product or a component or subcomponent of a product. Okay, so now here we sit in 174, and this is language that the IRS has argued the opposite way for the last 25 years under the R&D credit rules, where they've said, okay, if we look at the four-part test, the first thing is identify a business component. And the business component has been a product, a process, a technique, a formula, an invention, or a computer software. So those are the six that are in there. You didn't hear the appropriate design of a product. You didn't hear a component of a product. Now this language is in here. And so for 174, it'll be interesting to see in a 174 audit situation, is the IRS going to come in and say, listen, if you're an engineering firm and you're doing design for someone else, you now have 174 costs, okay? But over here on the R&D credit side, since the four-part test doesn't identify appropriate design or component or subcomponent of a product in the business component language, you don't get the credit. So the argument again in 174 is this is R&D. On the R&D credit side, they've argued the opposite for decades. So that is an interesting thing that's happening. And so maybe down the road, we get some better definitions for the R&D credit purposes that will allow design without question as a business component for the research credit. The next thing as we move through this 2363, there's some costs that they say, they being the IRS, these are things you need to consider You need to consider all your labor costs, all your supply costs, maybe some patent costs, operation and management costs, travel costs. Wow, there's one you would never think you would have to consider in an R&E environment, but there it is. And then they also give us a little good news. There's some things that they say just inherently, I guess, are overhead that you would not allocate or excuse me, G&A really. And so those are payroll, HR, and accounting, interest on debt to finance your research activities if you're borrowing to do these things. And then an obvious one is the amortization cost that you're already deducting on your identified 174 from prior years. So again, if you really look at what the IRS is saying in 2363 is there's a lot of things to consider that go way beyond what you would consider under an R&D credit under Section 41. Okay, so let's get into and just have a quick refresher on some differences you might see, credit versus 174. So remember, as we look at 174, gross wages are the ones that we include. So that's if you think about the R&D credit, we're always picking up box one, and so that excludes a lot of non-taxable wages, most notably your 401k amounts that your employees defer. Those are not considered in the R&D credit calculation, but your box one plus that 401k deferral plus any other benefits that are non-taxable will be included here in the 174 computation. So it's like it says in the second bullet point there, it's the loaded employee costs. So you got to consider all the other benefits that they're getting as well. And then also here in the wage side of things, foreign wages, you specifically exclude anything that you're paying on foreign wages in the R&D credit. You have to be sure we pick that up here under 174. I'm going to skip the least cost of computers. We don't see a lot of that these days, so it's probably not relevant. It is just there to be aware of. Contract research. Gosh, what a big one here. In the R&D credit, if you have 100,000 of contract research, you plug that into your credit computation and it haircuts it. You only get 65% of it. So in that example I just gave, 65,000 out of the 100,000 you paid for contract research is what goes into the credit computation. The whole 100,000 though that you paid out, there's no haircut under 174. That whole 100,000 has to be added back into your capitalized R&D costs. Supplies, generally that would be when we think supplies R&D credit wise, it is things that go into say a prototype, expendable materials that are not going to be recoverable and not going to have any value or be able to be sold after the R&D process is completed. So those things are included. 174 says, hey, we may need to go out and pick up supply costs that are incidental or to be allocated through an overhead process. So again, another expansion of cost. So those were some specific differences in looking at 174 versus 41. But this, I'd like to spend a few more minutes on the research, the contract research, and how financial risk plays into 174, because we all know but over on the R&D credit side, we've got financial risk if we have certain payment terms and we retain substantial rights in the research as the researcher. So something that's never really been well defined by the Internal Revenue Service before is the research provider concept and the research recipient concept. Okay. Now, those have been argued throughout the last couple of decades in the courts. So we've got some cases out there that are um, that define what financial risk is and when a researcher has that risk. So those would be the Fairchild case from way back in the mid 90s. Would also be more recently a company called Dynetics, and then another case called Geosyntec. I'm sure all of you have heard of that if you've heard of those cases, if you've been dealing with R&D credits in the past. But here in 2363, the IRS is saying we're going to define what a research provider is, and then we're going to define who the recipient is, and then we're going to talk about what an SRE product is. All right. So remember, we've got this concept of maybe one taxpayer is contracted to do research for a research recipient. Okay, so the one who's contracted would be the research provider. And so let's think of somebody who's maybe hired to do some research, an engineering firm hired to do research on how to construct something for, say, a state Department of Transportation. So the State Department of Transportation would, in that case, would be the research recipient. And now what is the product they're working on? And so 174 goes further and it adds some things. So remember, we talked about business components for the R&D credit. You see over here in the box on the right, we've got process, formula, invention, technique, computer software. But notice that they've introduced these two words here, a pilot model or a patent. And so they've added a couple of things here. And again, the idea is to broaden the scope of what is considered a specified research expense. Um, so again, remember financial risk or economic risk. I prefer to use the term economic risk because economic risk is a concept of two things. Who has the financial risk of failure? So let's look at this slide here. And then do you retain rights? So economic is kind of a combination of right retention and financial risk. So 2363 says that if a research provider is performing research activities, the SRE, these are SRE expenditures, in other words, have to be capitalized if the research provider bears the financial risk. And so that is the risk that the provider, my engineering company, in my example, working for the State Department of Transportation, that engineering company bears the financial risk of failure in the research, and they are financially obligated to complete that research. Then they have the financial risk. Now, this isn't a discussion of financial risk today. It's way too in depth to get into that, but they're basically in these first two bullet points affirming what or restating what the court cases have generally said over the past 20 years. Now, the last bullet point is very interesting here. For research credit purposes, the right retention has always been an issue. In other words, if you in your contract, again, my engineering company working for the DOT says all of our design, drawings, schematics, those things are going to be turned over to the customer. The IRS's argument has been there's no right retention. On the flip side, the taxpayer has always argued that we do have the right. We don't have to license or pay a license fee to use those research techniques in other products. So we are retaining rights. Well, here, the IRS is coming in and saying a research provider is not, treated as having the right to use an SRE product, if that right is available only upon obtaining approval from another party, another unrelated party. So that's an interesting take because I love how they have the double negative here. A research provider is not treated as having a right to use the product. So here they're saying, think of it this way: we're not retaining any rights if that right is available only upon obtaining an approval from another party. So again, this may be just like if you remember the appropriate product design component and subcomponent of a product. Remember that language might provide opportunities for R&D credit arguments in the future, and so might this language. So again, it's interesting. They may be setting themselves up to lose arguments on the credit side down the road. All right, there's a couple of things here that I think will be interesting. Some of our clients have said, we do all of our business on a long-term contract basis, and we do our accounting on a long-term contract accounting method, a percent complete. And so we're going to continue to do that. And so we don't have to amortize our costs. Well, 2363 came in and said, nope, you can't do that. We specifically, if you're going to do a percent complete, the only cost you can consider in that percent complete is the actual amortization deduction, not all of the costs, but only your amortization deduction can be included in your percent complete calculation. So effectively did away with that planning idea. So there's a couple other things that I'd like to mention that came up recently, actually after we had this presentation prepared, and one of them is in the mergers and acquisitions area. So a lot of businesses out there are looking to either grow by acquiring other similar businesses, or maybe you're on the other side of that and you're getting to a point where you'd like to roll up and see the advantages of being part of a bigger organization. So whether you're on the buy side or the sell side, it's very important to consider the 174 adjustment in your negotiations. So let's say that you're again an engineering firm, and you're going to sell upstream. The buyer is going to come in and they're going to be in their due diligence looking to see if you have addressed 174. It's going to be on their due diligence checklist. And so if you haven't addressed it, they're probably going to, help you address it throughout the purchase price negotiation, right? But the interesting thing here is the way the IRS has set up the abandonment and disposition rules that relate to R&D costs, capitalized R&D costs. 2363 is really, really very restrictive on what you can do with these costs. In other words, if I buy a computer and I'm going to do, so let's just say I don't do 179, I don't do any bonus depreciation, and I write that thing off 20% a year, and I get to the third year and drop it, it's useless. Well, I've depreciated, again, I'm simplifying this, but I've depreciated about 60% of it. And I've got 40% of my cost basis left, but the asset is gone. I write that remaining 40% off in that year. Well, 2363 addresses that with R&E costs. And we had a client recently looking at this. They had done a bunch of research. Some of the ideas did not move forward, and they wanted to write them off. They wanted to get the deduction themselves in the year that they're going to sell, right? So I'm going to sell off, want to have a clean slate, want to be able to take our losses on these R&D projects. Well, 2363 says, nope, You cannot dispose of these assets. You must write them off over a 5 year or a 60-month period. You have to. There's no abandoning of the R&D asset. Okay. So that's not good news for the taxpayers. But think about how that works in an M&A situation where you now have to consider what's going to happen to those costs if I do sell out. So same example, I move forward, sell the business, and I've still got several years of my R&D costs left. The buyer gets to take those as a deduction. So how does that factor into a purchase price negotiation? You're giving up a deferred tax asset that's moving forward. It's going to have to be considered. So 174, I think, is going to be a big issue, whether you're the buyer looking at it saying, hey, I'm going to get to amortize some costs. I'm going to get some a deferred tax asset out of that. It's going to be a real deduction. Whereas the seller might say, those were our costs. We want it accounted for in the purchase price somehow. So will be a big deal. The other thing to remember is about the only way that we've seen that you can actually write these costs off is if your entire corporation gets liquidated and goes completely out of business. So if that happens, you can write those R&D, unamortized R&D costs off immediately. But if you do any type of 381 transaction, stock sale, asset sale, reorganization, all of those will not allow you to write those off. So very, very restrictive on how you can dispose of these assets. So keep that in mind, particularly as you're moving through the M&A world. All right. I'm not going to spend a lot of time here as we're coming down to the end of our time together today. Identifying and allocating costs. Jordan is going to provide everybody with these slides. The idea here with this slide and the next couple of slides is to just to suggest an approach. And we've seen all different approaches here with 174. Some people start with their R&D computation. Some people start from scratch with this previous slide, for instance, where they're just trying to create maybe not an overhead, but a separate research and development cost pool to go along with their overhead and G&A. So there's a lot of different ways to do it. The suggestion that we're going to make is be sure you have it well documented. And you need to have it well documented, even if you decide you don't have any 174 costs, and that's going to be your position going forward. Our suggestion is to document why you don't have those. I'm going to skip a few of these slides here because we're tight on time as we come to the top of the hour. It's more slides on allocating these costs and actually doing the computation. And I'd like to, as we get ready to close here, just leave you again with an example that talks about the effect of this amortization and why it is so costly to taxpayers. And so we've got a little example here that runs through the amortization. And again, don't get too caught up in the numbers here. We're sharing this with you because as we've worked with some of the congressional offices in trying to explain to them why this is such a harsh impact on taxpayers, they'll look at it and they'll go, well, if you're getting to amortize these costs, by the time we get to the 5th year, and by the way, we're 2 years through it, and we're now in our 3rd year of implementing this. So, we're going to be halfway through the process. Why should we go back and change this, is what some of these congressional offices are saying. Because once you get to the 5th year, there's no effect. You've caught up. You're deducting 20% of of each of 5 years activity, there's no effect. Well, let's just say for a minute that you've got this taxpayer here with 2.2 million in R&D expenses. So that's your 174 cost for the year. And let's assume a 30% tax rate just for discussion here. And 2.2 million will generate right at 175,000, just a little less than 175,000 of an R&D credit. Well, you can see at the bottom here how the amortization is going to play out for each year. And again, my example is that the R&D expenses are the same every year for 10 years. And the reason I'm doing that is I want to show you that even if your R&D costs stay the same, there is still a deferred impact after 5 years, and taxpayers are still suffering with basically a tax that has been prepaid. So if we move to the next slide here, what we end up with is kind of a with and without. The top half of this slide here, we get the 175. If we're only getting to deduct 10% the first year, we get a deduction for based on 221,000, and then an R&D credit of almost 175. That's 241,000 in total tax benefit. Whereas if we slide right down to the second section, it's an $839,000 benefit if the taxpayer gets to deduct the full 2,214,000, right? So it's the 30% of that number, the deduction, plus the approximately 175 of R&D credit. So the difference is 598,000. That's significant given, just in this fact pattern. And so if we move forward across the slide now at the bottom, we've got an unfavorable, or an M1 basically every year, that's going to result in a tax effect. Second year, it goes down to 465, still not great. And if you go all the way over to the fifth year there, it's a small amount, 66,000 of tax effect, negative tax effect to you. But the cumulative effect of that is, as a taxpayer, you're deferring 5,537,000 in the bottom middle there of tax deductions. That's what's been deferred. And furthermore, you have basically prepaid the tax because you haven't been able to deduct that 5 million, that cumulative 5 million. So you've got a prepaid tax in under these facts and circumstances of 1,661,000. And so as we move out to the later years in the example here, what ends up happening is that just stays deferred. You'll notice there's no book tax difference. There's no current year tax effect if my R&D costs stay the same. But now I've prepaid that tax and it's out there forever. So when you talk to your Congress people, if you choose to do that, you might hear, oh, the effect evens out after 5 years. It does not. As a taxpayer, you have prepaid your tax and it will stay out there forever as long as there's a capitalization and amortization requirement. And it gets worse if your R&D costs increase over the years. Remember, this is a static example of they stay the same. So there is a tremendous impact of 174 on businesses, and in particularly small businesses that operate as LLCs or S corps, because they're the ones that are going to be paying tax at the individual rates, which are still up in the 30% plus range, instead of the corporate, the C corp rate, which is down at 21%. So very significant impact to the small business community. Well, with that, we are running out of time today. So I'd like to just thank everybody for being on here today. Certainly, if we didn't get to your questions, please continue to leave them in the chat chat box for this webinar. Jordan will collect those and get back to everybody. And again, we just want to say thank you very much for attending and have a great rest of your day.
Thank you so much. Thanks, Mike.
All right. Goodbye, everybody.